Meet Sarah. She believes real wealth is built with brick and mortar, one rental property at a time. She's the kind of person who trusts what she can see and touch, that she's building an empire from the ground up, collecting rental checks, and watching her property values climb. And then you've got Tom. He's convinced the path to riches is paved in the AI revolution, and he's betting on high growth tech funds to digitally skyrocket his net worth. And Tom operates in a world of charts, algorithms, and breaking market news, building his fortune with the click of a button. Here's the kicker. Both started with the exact same amount, $100,000 5 years ago. One now has a portfolio of physical properties, the other, a digital empire of stocks. Who made the smarter choice? And who's actually wealthier today? The answer isn't what you'd expect, and it'll probably change how you think about your own financial future. Let's break it down. So, before we go out and crown a winner, we need to understand the game. When we say Sarah is a real estate investor, we don't just mean that she bought a nice house. She bought an asset. Real estate investing is the business of owning property, a single family home, an apartment complex, condo. It could be a mobile home. It could be any of these. And the idea is we're going to use these assets to generate an income and we get to watch the value grow. So Sarah's strategy is tangible. I mean, she can physically hold it. She can drive by her investments. She can oversee the renovations. She owns a physical piece of the world, and her wealth is built on land and leases. Tom, on the other hand, is a stock market investor. This isn't a trip to Vegas throwing money on random companies. Tom is buying ownership in some of the world's biggest and most innovative businesses. By investing in a high growth tech fund, he owns a tiny slice of hundreds of companies all at once. His strategy is liquid, which means he can turn it back into cash pretty quickly, and it's relatively easy to scale. He doesn't have to deal with tenants or leaky faucets. His empire lives on a screen, ready to go anytime, anywhere. These are two totally different philosophies. Sarah is playing a game of leverage, tax breaks, and physical control. Tom, on the other hand, is playing a game of liquidity, diversification, and hands off growth. Both can make you incredibly wealthy, but the journey, the risk, and the rewards are worlds apart. So let's start with our good old buddy, Sarah. So in Sarah's world, why would anyone pick the tough-looking path of property ownership over the simplicity of the stock market? And it all boils down to one word: leverage. Leverage is the superpower in real estate. When Tom invests $100,000, he's buying $100,000 of stock. Exactly that, no more. Now, of course, there are super advanced strategies where you talk about like options and things like that. But for this particular situation, we're going to focus on what most people are doing when they invest in the stock market. Most people are spending $10 on stocks and they receive $10 worth of shares back. So if his stock goes up 10%, he makes $10,000, right? Simple. But with Sarah, she's playing her game a little bit differently. And so when Sarah uses $100,000, she's not just receiving $100,000 worth of property. She's using that as a 20% down payment to get a loan and buy a $500,000 property. She's using the bank's money to control a much, much larger asset. Now, let's say her property value also goes up by 10%. The property is now worth $550,000. That's a $50,000 gain, and that's not just based on the value of the $100,000 that she invested. That's based on the value of the asset that she controls. And because there's a 10% growth on a $500,000 property, that means that $50,000 that she invested is actually a 50% return on the money that she put in. She put in $100,000. She made $50,000. And this is the mind-blowing power of leverage. Now, it's probably worth at least throwing in the caveat. Yes, leverage gives you the opportunity to make more than what you put in. Leverage also gives you the opportunity to lose more than what you put in, i.e. that if the entire property goes kaput and she tries to sell it and cut her losses would be tied to the value of the property that she sold versus the loan that she took out, which means that she has the ability to lose a lot more than $100,000. Your investment of $100,000 in the stock market, because it's not leveraged, you're just on the hook for that $100,000. You can't lose more than that as long as you're not options trading and cutting things short, which again are very advanced strategies. So I assume that that's not going to be what you're doing early on. And so I think you can probably recognize why real estate still creates so many millionaires, because you do have that leverage. But that's not all. Sarah's second huge advantage is cash flow. So every month her tenants pay her rent And after she pays her mortgage, her taxes, her insurance, she set money aside for rental repairs because she's not gambling. She understands that there will be stuff that breaks and she needs to fix it, that she's a responsible landlord. What's left after that is pure profit. And so it's a steady, predictable stream of income that hits her bank account every single month. While some stocks, they do pay dividends, it's hard to match that kind of consistent income a well-managed rental property can provide you. Next up is taxes, and this is where real estate really pulls ahead. The government offers incredible incentives to property investors. Remember, we often talk about the government has two desires for us. One is for us to have a job and pay taxes, which is why business owners receive a lot of tax breaks. And two is for us to not live under a bridge and have a home to live in. And that's why rentals are also receiving incredible tax breaks. And so because of this, Sarah can deduct almost all of her expenses, the mortgage interest, the property taxes, the insurance, you name it. But the biggest tax benefit is called depreciation. The IRS lets her deduct a part of her property's value from taxable income each year for wear and tear. Then even if the property is actually increasing in value, this creates what we would call a passive paper loss, and you can use that to offset some of your gains, so you get to shield some of your rental income from taxes. Finally, real estate is an incredible hedge against inflation, and I'll put a link to another video where I go through some of those inflation hedges. When the cost of everything else goes up, so does the cost of rent and the value of her property. Her asset and her income grow right alongside inflation, protecting her financial power over the long term. Now, of course, it's not all sunshine and rainbows. I'm sure you're well aware of that. You're almost sitting there in one of those timeshare rentals where you're like, okay, what's the catch? And so Sarah does face what we call the hassle factor. As a landlord, she gets that 2 a.m. call about a broken water heater. She has to find new tenants when they move out. She has to deal with surprise repairs that cost a fortune. Her money is also not liquid. She can't just sell her bathroom if she needs quick cash. Selling a property can take months, if not years, and that can come with hefty costs. Sarah's path takes work, patience, and a very, very strong stomach to deal with a little bit of uncertainty. Now let's flip over to our good buddy Tom, who's investing in the market. So while Sarah's dealing with contractors, Tom is sipping his coffee, enjoying himself, looking at the single numbers on his screen. His approach is built for the modern world, and his perks are very enticing. Tom's number one advantage is liquidity. This is the complete opposite of Sarah's situation. If Tom wants to take a trip, buy a car, he wants to jump on a new opportunity where someone's like, "Oh, you want to join my business?" He can sell some stocks and have the cash in his bank probably within a couple of days. In fact, I had a client that called me up and they were like, "Dre, I am getting married. I need to have access to my money." And we found out how much she wanted to take out and we sent it to her and she had it within a couple of days. It would be very difficult, if not outright impossible, to be able to do that with rentals. That flexibility is the kind of freedom real estate just can't offer. Sarah's wealth is tied up in a building. Tom's is fluid as cash itself. Next is the incredibly low barrier of entry. That Sarah had to have a huge chunk of money that was saved up. She had to have $100,000 to get that property. And Tom, on the other hand, he could have gotten started with $100, $10. Now, he may have wanted to wait till he had his first $1,000 where he would have put his $100 in his account every week or every month, however he would have did it. But he could technically have bought fractional shares. He could have bought each share as he put the money in his account in cash. It's a much, much lower barrier of entry. And the stock market is probably the most democratic wealth building tool in history. Anyone with a smartphone can go out there, download the Robinhood app. And I'm not saying that that's the one you need to use. I'm not telling anyone, but it's the idea that I could download an app, I could open an account, I can link it to my bank, and then I can immediately start choosing stocks and funds. And there is some risk in that, where I do see people where, because investing has been gamified so much, that there are other people who just like the thrill of trading. And I'm like, well, if you bought a company based off of certain metrics and you like those metrics, just hold the company, at least until the metrics change. And realistically, we shouldn't be buying a company unless we believe that company is at least going to be a good idea for the next 5 years. And now things change. Obviously, things change. But that should be the premise that we start with. We shouldn't just buy something because someone said it's a good idea. We definitely shouldn't buy something because we got a notification that said our streak is ending. Now, I don't know if we've gone that far where we have streaks that we have to keep doing investing and trading. But I am saying that there are small nuances of gamification that I am seeing that is slightly concerning when it comes to having a long-term investment approach versus solely gambling and the thrill and the dopamine hit of choosing stocks, right? We're not gambling. Please do not be gambling with your investments. But this also means that Tom can technically purchase more shares. He doesn't have to start saving again to buy his next property where he's going to have another $100,000 in a year or two or three. Tom can continue investing his money. That if he gets a bonus, then he can put that $1,000 in there and he can purchase more stocks. That if he has a little bit extra money from a trip or something, that he can purchase more stocks. And so as you can tell, he can put in $500 here, $50 there. And so it's not that much effort that's required. It's not like trying to save up for another down payment for your next property. Tom can buy more stocks that next day or that next week. And that leads right into Tom's third weapon, which is diversification. With a single purchase of the NASDAQ 100 ETF, Tom instantly owned a piece of the 100 most innovative companies in the entire world. And he's spread across technology, healthcare, consumer goods, and more. And if a company tanks, it's balanced out by the others. For Sarah to get that level of diversification, she needed to buy properties in different cities or possibly different states, and a process that would require millions of dollars in a logistical nightmare. And Tom did it in seconds. And then there are, of course, the historical returns. While real estate offers steady growth, the stock market has historically been a wealth creation powerhouse. Over long stretches, we know that major markets like the S&P 500, the Russell 2000, or even the NASDAQ 100, that they, generally speaking, deliver higher average annual returns than real estate, especially if you reinvest the dividends. Finally, Tom's investment is truly 100% passive. Once he buys his fund, his work is done. He has no tenants, no toilets, no termites. He's not a landlord, he's an owner. He gets to benefit from the hard work of thousands of companies and millions of employees, all without ever taking one single late night phone call. But Tom's world has its own terror. He has his own problems, and that is generally speaking going to be volatility. He has to be tough enough to watch his net worth crash by 20, 30, 40, even 50% during market downturn and not panic sell. His wealth is just a number on the screen, and the red days, those could be stomach turning. And he can't see or touch it, which for a lot of people feels way riskier than owning a solid building. And so we laid out the battlefield. On one side, we have Sarah with her tangible cash flowing properties. On the other side, we have Tom with his liquid diversified stocks. Before we run the numbers and reveal who actually came out on top, if you find this useful, do me a favor and hit the like button. And drop in the comment below whether you're Team Sarah or Team Tom so far. All right, it's the moment of truth. Both Sarah and Tom started with $100,000 5 years ago. From late 2020 to late 2025, who's wealthier? Let's run the numbers. All right, so we have Sarah starting with $100,000. Then we have Tom also starting with $100,000. And then we know that Sarah was able to use that as a 20% down payment, which means that she then had access to a $500,000 property. And over the last 5 years, the housing market has seen major appreciation, even with some of the recent cooling. So between early 2022 and early 2025, the U.S. housing prices surged by nearly 55%. I know, right? It's kind of crazy. But assume we had a 6% growth rate per year, which is about what it is kind of on average. And so with that, a $500,000 property would now have appreciated to $669,000. Congratulations, Sarah. And so over those 5 years, she's been paying down her mortgage. And remember, her mortgage, she has access to $500,000. She put $100,000 down. So that meant her mortgage would have been $400K. All right, so then we'll estimate that she has paid down $35,000 from her mortgage, which now means that she owes $365,000. And her equity, the value of her home, minus her debt. So what we'll do is we would then take that $669,000 as the value, and then we'll subtract what her mortgage currently is, and that will leave us with $304,000. Congratulations again, Sarah. But with Sarah, there's more. And don't forget her cash flow. So let's say after all the expenses, after she paid her mortgage, her taxes, her insurance, and the maintenance, that she netted, let's just say like $300 a month. Right? We'll just be kind of modest. And so we'll say the $300 a month, and then we would say that she received that for 60 months over 5 years. And so then that would give her $18,000, and that is in her rental income, or at least what we'll say is her net income. So Sarah's total net worth from her investments in her equity plus her cash flow is that $304,000 plus the $18,000, which brings Sarah to $322,000. So again, congratulations, Sarah. So that means that she has more than tripled her original $100,000 investment. So now for Tom. So let me go ahead and let's switch over to Tom. Probably do us a favor and zoom out a little bit so we can see everything. Not that far out, just a little bit so we can see everything. All right. So what we're going to do is we're going to say that Tom invested in an index fund for the NASDAQ 100. So that's the QQQ, and that's the Invesco ETF. What they've had is a 17% annualized return over that period of time. And if you had a 17% annualized return, while that is a very strong return, it is not unreasonable nor impossible. And what that would ultimately mean is if you had 17% growth every single year, and that means that Tom now has $219,000 in his firm. And so Tom has doubled his money, right? And so there you have it. On paper, Sarah is the clear winner. Her investment created a net worth of $322,000, while Tom's is $219,000. She's over $100,000 richer. The surprise and the overwhelming reason for her win was the power of leverage. But hold on, is net worth on a spreadsheet the only way to measure a win? And this is probably where the story gets a little bit interesting. So while Sarah's number is bigger, her $322,000 is trapped. It's illiquid. To get that money, she has to either sell the property, a slow process costing 5 to 6% by the time you pay all the fees, or to do a cash out refinance, which comes with its own cost at a potentially higher interest rate. Tom's $219,000, however, is completely liquid. If a family emergency strikes or if he has a once-in-a-lifetime business opportunity and that pops up, he can get the cash ready in a couple of business days. And that kind of flexibility is a form of wealth that you can't measure on a balance sheet. For many, Tom's freedom makes him the winner. And what about stress and scale? Tom's journey is almost effortless. He clicked the button, he did nothing for 5 years. Sarah, on the other hand, had to put in some sweat equity for that extra $100,000. She screened tenants, she managed repairs, and she dealt with all the anxieties of owning property. Was the extra money worth the extra work? If we're an entrepreneur who loves building things, probably. But for a busy professional who values their free time, maybe not. Now, think about the future. If Tom gets another $10,000, he can invest it in seconds. He just goes on his phone or he goes on the computer and he goes to his app, he logs in, he sends the money in right away. If Sarah wants to buy another property, she has to start all over, save another huge down payment and get another loan and hope for the right deal. Tom's strategy is way easier to scale. The outcome almost really depends on the market conditions that we picked. If we started this in early 2006, right before the housing crash, Sarah would have been wiped out completely and the stock market recovered much quicker than the housing market did. A long stock market slump, on the other hand, like the lost decade of 2001 to 2011, well, that market slump, on the other hand, basically would have flattened out Tom's portfolio while real estate was still holding strong. So who wins the battle between Sarah and Tom? And the truth is, as we often discuss, it depends. And that a lot of times that's what are we measuring by, right? Like we talk about that from a school perspective. And I love that that meme that goes around that's like showing a bunch of kids in schools, but they're as little animals. And the idea is, well, today we're going to measure how well you can climb a tree. And the shark is looking like, oh, well, I'm out. And then the monkey is looking like, oh, bet this is a great day. But if you went to school that day and they said, hey, we're going to measure how fast you swim, Well, now the shark is like, I'm spectacular, and the monkey's like, I'm screwed. And so it really does depend. And so there's really no one single champion. The winner is completely dependent on who you are and how you value these things. If you're Sarah, only wants maximum control, who sees debt as a tool, and who is willing to put in the work for the cash flow and huge tax breaks, then real estate is a no-brainer. That's the path for you. If you value tangible assets and incredible power of leverage, again, real estate is the option for you. Now, if you're someone like Tom who values your simplicity, your freedom, and your own time above all else, then the stock market is your arena. You want your money to work for you passively, enjoying the fact that it's totally liquid and it's already diversified without the landlord headache. But the real secret, and if you've been following me for any time, you know what I'm going to say. The strategy that's used by the smartest investors where you don't have to actually choose one. The ultimate answer isn't Sarah or Tom. The answer is Sarah and Tom. And that the most powerful wealth strategies are hybrids. They use the stock market for liquid, diversified growth, and they use real estate for stable cash flow, tax advantages, and a hedge against inflation. So they might own a few rental properties here like Sarah while consistently investing in low-cost index funds like Tom over there. And for real estate exposure without the landlord duties, you might even be interested in exploring REITs, real estate investment trusts that trade just like stocks. By combining both, you get the strengths of each while protecting yourself from their weaknesses. You build a tough, diversified portfolio that makes you money from all angles, no matter what the economy is doing. So now that you've heard the whole story, who do you think really won? Let me know your final verdict in the comments. And if you want to learn how to build a hybrid portfolio like the one that we just talked about, I'll put a link in the show notes so you can schedule some time on my calendar. We got a complimentary discussion and how you can create multiple streams of income to have more wisdom and less worry. Don't forget to subscribe so you continue receiving valuable insights on how to create your own wealthy retirement system. As always, I'm Dre Griggs, founder of Ascending Wisdom. Until next time, stay safe and enjoy life.